Hello everyone, hope you had a good day. For today we are going to cover types of insurance, part 2, which focuses on permanent life insurance, a very important topic. A lot of questions can appear on the state exam as well. So permanent life insurance, it means two qualifications for that. There should be cash accumulation, and then also the insurance can last for life. So it's a permanent insurance, and also it has a cash accumulation. So what types of insurance are permanent insurance? Whole life, adjustable life, universal life, variable life. We're going to look into them. So having a good understanding of the entire picture will help you to understand and answer correctly concept questions, right? Now we're going to look whole life. Is characterized by a fixed premium and a fixed death benefit. It has a fixed premium and fixed death benefit, which means that the premium is set if it's a straight whole life, um, and then you pay until age 100 or until death happens, right? So uh, that's what it is. The premium is fixed, and then also the death benefit is fixed. Cash accumulation is not added to the death benefit, so the death benefit is what initially set in that. So that's whole life, right? So a whole life can be a straight whole life, which means that you make a payment every time until death happens or until age 100. The other question that you might see on the straight life is that whole life matures at age 100 or when death happens, right? There's also a limited pay whole life, which means that you pay in 10 years, you pay it off, right? In 20 years, you pay it off. Instead of paying for life, you pay a bigger premium within a short period of time. So limited pay whole life is a permanent life insurance, but the limited pay pertains to the payment and finishing off early, right? The limited doesn't pertain to the whole life, it pertains to the payment or the premium. And also there is a single pay whole life. You pay it off in a single premium, a big lump sum. You can pay it off in one, the whole life is paid off, and then it's a permanent life insurance. So those are on the whole life. So on the whole life, you might see from these three different types of whole life, which one accumulates better cash, right? Of course, the single pay, because you're putting all the money into the system, and then any interest accredited will be more than you putting in a small amount. So the least cash value is on a straight whole life, and the most cash value will be on the single pay whole life. And then always pay attention to the fixed premium and fixed death benefit, and then it can appear on your exam as well. What else is a permanent life insurance? Is an adjustable life. Adjustable life, it is because you can adjust it, right? You can adjust what? You can adjust the premium, the death benefit, and then the benefit period. So that's called an adjustable life. Questions pertaining to this one might be, what can you adjust in adjustable life, right? The premium and death benefit sometimes, and then the premium, death benefit, and the benefit period. So just knowing all those three that you can adjust, you can answer any concept question that comes in on the exam as well. Universal life is characterized by flexible premium and flexible death benefit, and that's why you don't have to pay the premium. You can lower it, you can put more money into it. That's called the flexible premium, and also the cash value is added to the death benefit, and then it's a flexible death benefit also, right? So in other terms, they can say what's a life insurance that has a variable premium and is characterized by a considerable flexibility, right? Considerable flexibility. So it's a type of whole life, but it has considerable flexibility because of those two flexibilities. So if you see on the definition as well, it might appear in the exam. All right. So other types of insurance that you need to pay attention is an endowment contract. It's also a permanent life insurance. An endowment contract matures at certain age stipulated in the policy. What does that mean? So when the policy is written, you want the death benefit to be available at the age 80, 85, right? So that's been written in the policy, and the premium is determined by what age you decided, but that's an endowment contract. So it matures, so you can get the money before you die, right? So the face amount is available at the specified age in the policy. So this is a unique, others, death has to happen to get the death benefit. If it's universal life, this has to happen to get the death benefit. A whole life, either you have to reach age 100 or death has to happen to get the death benefit. But endowment contract, you can get it at the age that's stipulated in the policy. Of course, you pay more in the premium for it, but that's a good option to have. Other contract that you need to be aware is a modified endowment contract. It's an overfunded according to IRS table. If you put more than what the IRS is allowing in that policy, and then the policy loses its tax advantage. So the policy loses its tax advantage, right? Now an endowment contract becomes the first out is taxable, right? The first out is taxable. So modified endowment contract, that's a good one to pay attention to. Another permanent life insurance is a variable universal life. You need security license to do that, and then the money is invested in a separate account. If you see any question saying separate account, your mind should be thinking a variable universal life or a variable life in that sense. So a variable life is a permanent life insurance as well. Why? Because the cash is being invested into a separate, and then the only type of insurance that has cash value is a permanent life insurance, right? Cash value is only available in a permanent life insurance such as whole life, universal life, variable life, endowment contract, right? And adjustable life as well. Other life insurance that you should be aware: specialized policies. A joint life policy pays benefits upon the death of the first insured, right? And then the joint life, there are two or more people involved and insured in the policy, and then upon the death of the first person, payment of the death benefit is a joint. Survivorship is upon the death of the last person. So good points to remember. Other specialized policies to know: family maintenance policy is a combination of both whole life and a term to provide income for a specified period beginning upon the death of the insured. So it helps the family. A juvenile policy converts the life of a juvenile, and no consent needed from the child. So the child doesn't sign. So beneficiary cannot sign any policy, and the child cannot sign any policy as well, right? Juvenile policy. A jumping juvenile, just think about 5 times the initial amount. So if you see 5 times the initial amount in the question, it must be a jumping juvenile. So it's adding the premium. So that's it, right? Corridor is a gap between the cash value and then the face amount. If a whole life has 100,000 in cash value, and then it's 500,000 in this benefit, so the gap between 100,000 and 500 is the corridor, right? STOLI is investor-owned life insurance that there is no insurable interest between the insured and the beneficiary. So waiver of premium rider pertains to total disability. So always attach total disability with a waiver of premium. So that's a good thing to know as well. Now we're going to see some example questions, right? Which of the following have an increased premium after a given period of time? So it's going to increase in premium after a given period of time. So it's straight life, 20-pay life, decreasing term, convertible term. So because we have covered the term life insurance on a separate video, and now we are covering the permanent life insurance, should be answering this question, right? Convertible term has the premium is going to increase, right? Increased premium. The same thing, renewable term has increased premium. Every time you renew it, it's going to end up with more premium as well, right? But the straight life is the same as a fixed premium, so that's pertaining to a whole life, right? Policy owner makes a payment of 100,000 whole life for 10 years, and the cash value is 15,000, right? 100,000 whole life, and the cash value is 15,000. If the insured dies, how does the beneficiary get money? So it's 85,000. Subtract that, and then 115, 100,000. So the answer is 100,000 because it is a whole life. It's a fixed death benefit. The cash value is not added to the death benefit. All right. So if it was a universal life, how would you treat that? A policy owner makes a payment of 100,000 universal life for 10 years. Cash values of 15,000. If the insured dies, how much does the beneficiary get? Right. So universal life is flexible premium. So the cash value is added to the death benefit. Now the death benefit becomes 115,000. 115,000, right? Why? Because flexible death benefit and flexible premium for universal life. So these two might be confusing for a lot of people. Whole life, universal life. If they bring numbers like this, just know whole life is fixed, universal is flexible, cash value is added to the death benefit for universal life. Any loan taken out is subtracted from the total death benefit from universal life, and if any loan has been taken from a cash value, that loan is subtracted from the 100,000 for a whole life, right? For a whole life. So, all right. The following are characteristics of a whole life, except whole life has what? Flexible premium, guaranteed dividends, fixed death benefit. So the following are characteristics of a whole life, right? Whole life is flexible premium and flexible death benefit, we said. So the only exception is guaranteed dividends. Dividends are never guaranteed in life insurance. Dividends are never guaranteed in life insurance, and that's a good thing to pay attention to. All right. So which of the following are all permanent life insurance policies? A whole life, incidental life term, variable life, whole life, universal life, a group life, whole life, and variable life. On the previous recording or class, we saw that a term life insurance doesn't have a cash value, so it's not permanent. A group life is also a term, doesn't have cash value, so the only thing that can be, so by elimination we eliminated C because of a group life, we eliminated A because of the term. The answer is variable life, whole life, universal life are all permanent insurance. If you don't know the whole picture, right, and knowing each element cannot help you to get a concept question like this, so it's good to pay attention to having the entire picture on the permanent life insurance and the term life insurance. How is the money in life insurance company general account usually invested? Common stocks, bonds, real estate, and mortgages, mutual funds. The best answer is B, bonds, real estate, and mortgages. All right. Hope this was helpful. Please subscribe, share, and like. We'll be uploading more videos as well. All right. Enjoy.